Hello everyone and welcome back to the Web3 Daily. The market today can only be described as a total bloodbath in just the last 24 hours. An epic flash crash swept through the entire crypto space without warning. Bitcoin and Ethereum led the nosedive, triggering a massive liquidation event of nearly $20 billion across all networks. Over 1.6 million people were wiped out, and market sentiment flipped from greed to extreme fear in an instant. It's absolute carnage out there. So, what exactly caused this sudden bloodbath? It was actually a perfect storm, orchestrated by macroeconomics, internal systemic risks, and high leverage. First, the trigger was geopolitical. Trump suddenly announced a 100% tariff on all goods exported from China to the US. As soon as this news broke, global risk-off sentiment ignited instantly. The US stock market plummeted, and our crypto world, showing a high correlation with stocks, began its own synchronized crash. This proves once again that in the face of true macro panic, the digital gold narrative still doesn't hold up. Bitcoin is still viewed as a risk asset by mainstream capital. Look, the price of actual gold was rising against the trend, which shows that, in times of extreme uncertainty, big money still chooses the most traditional safe haven asset. Of course, if macro factors were the spark, the thing that detonated the whole powder keg was our own internal problems. At a critical moment, when prices were plummeting, several major exchanges, including Coinbase, Binance, and Kraken, collectively experienced outages and delays due to overwhelming traffic. Just imagine, the market is nosediving, and you can't even make a trade. The panic that causes is lethal. Even worse, Ethereum's stablecoin, USDe, suffered a severe depeg, with its price once dropping below 66 cents, a decline of over 34%. When a so-called stablecoin collapses, it directly triggers concerns about the systemic risk of the entire DeFi space, and a crisis of confidence spreads rapidly, leading to a wider chain of liquidations. Finally, the high leverage prevalent in the market became the most powerful amplifier of this disaster. Data shows that the total liquidation amount across the network reached a staggering $19.2 billion, the vast majority of which were long positions. This is a classic leverage cascade. Falling prices trigger liquidations. The sell orders from those liquidations further suppress prices, creating a vicious cycle. Amidst this chaos, the activities of whales were also unusually active. Someone precisely closed a massive short position at the lowest point, making over $20 million. There were also long whales like Machi Big Brother, who had over $12 million in positions forcibly liquidated. You could say this flash crash was an ultimate stress test on the entire market, from its macro connections to its internal structure. Okay, so while the market was a river of blood, Washington wasn't sitting idle. A regulatory storm with potentially even more far-reaching consequences is brewing. A group of Democratic senators recently drafted a bill, and this thing is basically designed to uproot the entire DeFi industry. They're planning to create a so-called restricted list for any DeFi protocols they deem too risky. What's even more insane is that, for the first time, they are proposing to enforce KYC, Know Your Customer regulations on all crypto applications, and that even includes the non-custodial wallets where we control our own private keys. This is essentially trying to force the old-world logic of traditional finance onto decentralized open-source software. As soon as this proposal dropped, the entire community exploded. The well-known crypto lawyer Jake Chervinsky put it bluntly, saying, "This isn't regulation, it's an attempt to kill the entire industry." Coinbase's CEO, Brian Armstrong, also publicly warned that this path will severely stifle fintech innovation in the US, ultimately forcing all the talent, projects, and capital into an innovation exodus to places with more friendly regulatory environments. Let's be clear, if this bill actually passes, it won't just dramatically increase compliance costs for DeFi projects. It will create a decentralization paradox where protocols have to abandon their core decentralized principles just to comply. This could ultimately lead to the US completely falling behind in the global Web3 technology race. Now that we're done with regulation, let's look at the tech side. While the Layer 2 race is heating up, Polygon recently quietly completed a crucial mainnet upgrade called Rio. This wasn't just a minor tweak. It was a complete overhaul of its underlying architecture. The goal is crystal clear. They're going after the trillion-dollar track of global payments and real-world assets, or RWAs. There are two core components to this upgrade. The first is a VEBloP model. Simply put, it changes the old way where validators competed to produce blocks. Now, a small group of nodes is elected to be in charge. This basically eliminates the risk of chain reorganizations, making transaction finality almost instant. For payment applications, this is a game-changing experience. The second part is even more impressive: stateless validation. Previously, if you wanted to run a node, you had to store the entire chain's history, which was very costly. Now, with this technology, a node only needs a small cryptographic proof to verify a block, significantly lowering the hardware barrier. What does this mean? It means more ordinary people can participate in securing the network, making it more decentralized. The goal of this upgrade is to first boost the network's throughput to 5,000 transactions per second. It's obvious that Polygon is transforming from a general-purpose platform serving retail users into a professional financial infrastructure focused on the needs of enterprises and institutions. This is also a powerful response to the network's past stability issues, as they aim to regain market confidence with this complete architectural overhaul. Speaking of ecosystem shifts, another major, almost symbolic event has recently happened in our space. I'm talking about Phala Network. This project has always been a star in the Polkadot ecosystem, focusing on decentralized AI and confidential computing. And it was one of the very first projects to go through hell and back to win a parachain slot in the auctions. But now, their community has voted and decided that once their slot expires in November of 2025, they're not renewing, they're packing up and moving everything to the Ethereum Layer 2 ecosystem. This whole situation is actually quite interesting. Phala's exodus is the result of a well-thought-out strategic decision by the project team. The reasons they've given are very direct. First, to better align with the future tech roadmaps of hardware manufacturers like Intel. An EVM-compatible ecosystem is the inevitable choice. Second, and most importantly, they believe the Ethereum L2 ecosystem has stronger liquidity, richer development tools, and a larger user base. To put it bluntly, more people, more money, more opportunities. Third, renewing the Polkadot slot is too expensive, and the maintenance costs are high. They don't want to be locked into an infrastructure with limited scalability anymore. The implications of this decision for the entire industry are profound. First, it's a significant challenge for the Polkadot ecosystem. It suggests that in the face of the powerful capital efficiency and the network effects of Ethereum's L2s, Polkadot's technical vision might be losing its appeal for application layer projects. Second, this is yet another piece of strong evidence for the Ethereum-centric trend. Ethereum is acting like a massive gravitational field, constantly pulling in good projects and liquidity from other public chains. Finally, it also reflects the pragmatic balance project teams are striking between technical ideals and business reality. They chose the path that brings direct commercial benefits and user growth, and this could inspire other multi-chain projects to follow suit. Let's switch gears and talk about the eternal topic of privacy. In the crypto world, when you mention privacy, the first thing that comes to mind is definitely Monero. But privacy is never a one-and-done deal. It's a continuous battle of offense and defense. Recently, the Monero development team released a new client update called Florin Fermi, and is strongly recommending that all users upgrade. Why the urgency? Because they're fighting back against something called spy nodes. These so-called spy nodes are bad actors on the network disguised as normal nodes. Their real purpose is to monitor network traffic on a massive scale and try to link your transaction to the IP address that broadcasted it. Although Monero's technology is impressive, hiding the sender, receiver, and amount, if your source IP is exposed, your anonymity is significantly weakened. And this isn't just fear-mongering. Remember that internal video from Chainalysis that was leaked last year? It showed the blockchain analysis giant doing exactly this, using their vast network of malicious nodes deployed worldwide to trace Monero transactions. So, the core of this Florin Fermi update is a smarter peer selection algorithm. In simple terms, when your client connects to the network, this new algorithm can intelligently identify and avoid nodes located in large, centralized IP address blocks. Because those are the most likely nests for spy nodes. It's like in a continuous cat-and-mouse game, Monero has once again upgraded its counter-surveillance capabilities. It also proves once again that true privacy protection requires not only cryptography, but also the combined efforts of network protocols and the community. And now, let's turn our attention to the Solana ecosystem, where something big is happening that could reshape its entire DeFi landscape. Jupiter, Solana's largest trading aggregator, just officially announced that it's teaming up with the stablecoin up-and-comer, Ecina Labs, to launch its own native stablecoin called the USDe. So what's the big deal here? This move signals that Jupiter is no longer content with just being a trading app. It's evolving into a comprehensive DeFi platform with its own core currency. This USDe will be deeply integrated into all of Jupiter's product lines. Whether it's perpetuals, lending, or spot trading, it will be the core asset. And what's more, Jupiter plans to gradually convert the roughly $750 million of other stablecoins, mainly USDC, in its liquidity pool into its own USD. This playbook actually reflects a major trend in the DeFi space right now, the central bankification of top protocols. You see it on Ethereum with Aves GHO and Curve's CRVUSD, and now Jupiter is pulling the same move on Solana. By issuing and controlling the core currency within their own ecosystem, these protocols can internalize value instead of paying a seigniorage tax to external issuers like Circle. This not only boosts their revenue, but also builds a powerful economic moat. You could say these top protocols are evolving from mere applications into digital economies with their own monetary policy. Finally, let's talk about a major innovation in the stablecoin space. In a market dominated by USDT and USDC, where everyone is competing on reserves and yield, someone has quietly opened up a new front: privacy. The regulated blockchain platform Paxos recently announced a partnership with the privacy-focused Layer 1 public chain Alio to launch the world's first native privacy-preserving US dollar stablecoin called the USAD. The biggest highlight of USAD is its use of Alio's underlying zero-knowledge proof technology, or ZKP, to provide end-to-end encryption for stablecoin transactions. To put it simply, when you transfer USAD in the future, by default, who sent it, who received it, and how much was transferred, all this information will be encrypted, on-chain, completely invisible to outsiders. This design is a precision strike on the pain points of enterprise and institutional users. Just think about it. A company definitely doesn't want its competitors to see the exact salary amounts it pays its employees or the details of its payments to suppliers, right? The complete transparency of public blockchains has always been a major obstacle to large-scale institutional adoption of blockchain technology. USAD is here to fill this privacy gap. What's even more interesting is its compliant privacy model. On one hand, it uses ZKP to protect business privacy. On the other hand, if you need to, you can selectively generate and disclose compliance proofs of your transactions to regulators or auditors. This cleverly solves the dilemma faced by purely anonymous coins like Monero, which have struggled to enter the mainstream financial system because they can't meet anti-money laundering regulations. You could say that the emergence of USAD has expanded the stablecoin war from the single dimension of reserves and yield to a multi-dimensional battlefield that includes privacy, compliance, and programmability. Alright, that's all for today's Web3 Daily Report. If you found this helpful, please hit that like button to show your support. Every day we sift through the Web3 world to bring you the most critical information, the news that's closest to the money. We hope that by curating this content, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive registration links for major exchanges in the comments section below. These are special high rebate deals we've secured for our fans, and we hope they can help you save some costs on your investment journey. Let's stay rational, move forward steadily, and get rich slowly together in the world of Web3. May all of your crypto assets grow steadily. We'll see you tomorrow.